gold market is beginning to exhibit signs of stress. For starters, we've seen an unbelievably strong bull market emerge in gold, with it being up over 40% in just the last 1 year alone. The trend of central banks around the world stockpiling on gold has only continued to accelerate, but now we might see signs of another area of the gold market starting to break, and that is specifically with the Bank of England, as gold dealers sell Bank of England bullion at a discount because of apparently turmoil with tariffs. So a couple of things are happening here, and I think tariffs may be a trigger here, but it doesn't fully explain what's going on, as I will show you in a moment. Number one, we see gold in the vault at the Bank of England is trading at a discount to spot prices for gold. This is very strange. Typically, gold trades at a premium to spot. Even if it's a small premium, it's still a premium. It's also weird because this isn't industry-wide. This is specific to the Bank of England. So you have to ask yourself the question, why would the price of gold be cheaper coming out of the Bank of England than anywhere else? And it's not just a little bit cheaper. We are seeing quoted prices for gold at the Bank of England more than $5 per ounce below spot, whereas usually it trades at a premium of a few tens of cents. But this unusual price discrepancy is not the only thing happening. We are also seeing massive delays in these delivery requests being filled. Right now, the delays are up to a few weeks long. What we are seeing right now looks like a bank run where everybody is trying to get their gold specifically out of the Bank of England. Now we know in the past, the Bank of England has a history of confiscating gold that belongs to other nations. We saw this recently with Venezuela when the dictator in Venezuela tried to repatriate the gold. Bank of England just said no. Now you may agree with that position, but at the end of the day, the Bank of England was holding gold that belonged to another nation and refused to give it to them when they asked. We also have seen a history of other nations slowly repatriating their gold, seemingly because of a lack of trust by holding it at the Bank of England. We saw Poland do this, and over the last couple of years, they've repatriated basically all of their gold out of the Bank of England. And now it seems that there is somewhat of a bank run happening with everybody trying to get their gold out, and these delivery requests are being delayed. One reason for this delay could be that the Bank of England doesn't actually have the metal, that they have to go source it from somewhere else in order to fulfill the delivery requests. Now, this possibility of a bank run happening with custodied gold in major places like the Bank of England is something that people have been warning could happen for a very long time. That's why they've always said, if you own gold, make sure you actually have it. And if you are going to store it in a vault, make sure it's a private vault. As I've always said, make sure it's in a country with no history of gold confiscation, high degree of rule of law. You don't want to be storing it in a vault in America, which has confiscated all of citizens and the world's gold in the past. So you want to make sure you're storing it in a place that you have a very low risk of something like this happening to you. Now, another indication that this is a problem isolated to the Bank of England, it's not just, hey, everybody everywhere is trying to get their hands on gold and there's just no gold anywhere, is because these delays and this discount is only at the Bank of England. And while they do hold about 400,000 gold bars, that's compared to about 8,000 tons stored in London overall. But while those specific delivery problems seem for now to be isolated to the Bank of England, it looks like demand for gold is continuing to grow across the entire world. Right now, we're seeing tightness in the 1 month lease rates for gold have jumped to about 4.7%. And as mentioned earlier, we are seeing the price of gold just continue to break into all-time highs, and it's up about 40% over the last year. Now, one thing that I would like to point out here is the last time we had a very quick 40% gain in the price of gold was from March of 2020 through August of 2020. Now, admittedly, that was a much faster increase in the price, but that came as a result of all the money printing that the central banks, including the Fed around the world, were doing in response to government lockdowns. Now, while the price of assets exploded very quickly during 2020, it wasn't until about a year later in March or April of 2021 when the price of goods and services finally started to show signs of inflation. The reason why gold is bought up is because of stability. You have an asset that is not somebody else's liability. The supply is limited and scarce, which means it is a hedge against future inflation. And if governments around the world do decide to flood their economies with liquidity, you maintain your purchasing power. So the price of gold skyrocketing 40% over the last year may not be an indication that we are about to see another large wave of price increases, simply because we haven't seen a large wave of money printing. But it does indicate that the big money around the world that has enough demand to drive the price of gold this much higher is expecting some reason why they would need to preserve their purchasing power with gold, whether that's geopolitical uncertainty, central government actions, or central bank actions. Now, I can already hear the comments because probably everybody is thinking you cannot mention what is going on in gold right now without also talking about what's going on with silver. Don't worry, I've got you. Very similar strange things are happening in silver markets right now as well. SLV is the biggest ETF that custodies silver. And right now we are seeing some strange things happen with the SLV silver ETF. This is an image posted by Bob Campbell on Twitter, but you can see the borrowing fees at the bottom of this image on this chart have skyrocketed. In other words, if you want to short shares of SLV, right now you have to pay an interest rate in order to borrow those shares so that you can sell them, in other words, short them. And that interest rate has skyrocketed. Not only that, it is becoming extremely difficult to locate shares to borrow. Now, normally this wouldn't be the case with an ETF, but because this is an ETF that holds physical metal, it is becoming difficult to locate enough metal to be able to create new shares for that lending and borrowing. In other words, right now, if you look at gold markets and you look at silver markets, it looks like what we are experiencing is a lot of demand, and it's difficult to locate physical metal to meet that demand. The Bank of England says that it is the tariff premium and fears about tariffs that is fueling this clamor to withdraw gold. But given the fact that some of these weird issues are isolated to just the Bank of England right now, and we are also seeing increased sustained demand all over the place, including with silver, it looks like a likely explanation is big money has been stockpiling metal for a long time, supply is running out, and entities, potentially the Bank of England, who have been loaning out fractionally reserved gold, meaning they don't actually have the metal they say they do, are slowly starting to be exposed. Gold is one of those assets that you want to own before you need to own it. For thousands of years, it has preserved its purchasing power, which means you can buy the same amount of stuff with the same amount of gold, or in a lot of cases, you can buy more stuff with the same amount of gold. You can look at the price of a three-piece suit over the last couple hundred years measured in gold. You can look at the price of a haircut over the last couple thousand years. You can look at the price of an army captain over the last couple thousand years measured in gold. It is very consistent because those things don't get cheaper from deflation or from technology. Other things that do get cheaper from technology, like food production and shelter, you will see compared to gold, they actually get cheaper. In other words, your purchasing power slowly grows over time with those things. This is why I have recommended gold to be used as a savings account, putting a decent chunk of your overall net worth in gold so that you have reserves to rely on when assets go on sale or when you need some purchasing power. But again, it's something that you need to have in your possession before you actually need it. Otherwise, at that point when you need it, you might not be able to get it. If you've never bought gold before and you need to know the place to start, I've got a bunch of affiliate partners that I have linked in the description below my YouTube videos. That's where I would start if I were you. As always, thank you so much for watching. Have a great day.